Hey everyone, welcome back to a new video. In this lesson, I'm going to provide you with a comprehensive guide on how to spot high probability liquidity sweeps. So, what exactly is a liquidity sweep? Basically, it is a trade on a specific swing high or swing low followed by a reversal. The goal is to capitalize on that reversal move. If you are an ICT or SMC trader, you're probably familiar with the concept of liquidity sweep already. However, the challenge lies in recognizing that not every rate on a high or low is followed by a reversal. Many times, the price will simply continue in its original direction without offering any reversal. And to make matters even difficult for traders, there are instances where it provides false signals of reversals, leading to getting trapped and stopped out. I have experienced this, and I'm sure you have too. In this video, we're going to fix this issue, and you will learn exactly when to anticipate a reversal after a liquidity rate or sweep, as well as when to expect a continuation. I will outline 5 scenarios or cases, and once you encounter any of them on the chart, you will know that the price has a high probability of reversal. Each scenario will be backed by many examples so that you can train your eyes to identify them in real time. And now, let's dive in. And now let's start with the first scenario, which is a sweep on liquidity near or at a PDRA. I repeat, a sweep on liquidity, meaning a rate on a swing that is located near or inside a PDRA. And let me draw you an example on the chart so you can understand it better. So let's say, for example, we have an expansion to the downside, right? That expansion lifts a fair value gap. So this is the PDRA. Now the PDRA right here can be a fair value gap. In our example, it can be a breaker or an order block, right? A rejection block. But in most cases, you will see that the order block and the fair value gap repeats a lot of time. So let's continue. Price after this expansion, you will see the next logical move is, of course, retracement. So price will do this. Starts retracing. Maybe it will form a swing high right here, right? And now it starts going lower, breaking this swing maybe. And one more time, taking liquidity from this swing high. And now you are telling yourself, maybe this is a break of structure. But in reality, this is only a sweep on liquidity, and price after this sweep, it will displace lower in an energetic move right here. So this is the first fall. You have a sweep on liquidity, right? This swing took liquidity from this swing right here, and this swing is located inside a fair value gap. Now this swing right here can be located here, so it is not necessary to be inside that fair value gap. It can be near or inside the fair value gap. I started with this scenario because this is one of the highest probable liquidity sweeps in the market. Again, this PDRA can be also an order block. From my experience, I noticed that you'll see this formation happens a lot in fair value gap, in the first degree, right? And then order blocks. Breakers, not really. Breakers usually one top and just shoots higher or lower. So again, this fair value gap can be an order block. So maybe like this, you will see a swing that is just below that order block, and price will rate on that swing with a fake market structure shift. So you will see, so this move right here will be like a displacement, and you think that price wants to go higher, and after that it reverses. Or this swing right here can be inside that order block, right? And price will rate on that swing. So first of all, you will notice that it will give you some kind of fake signals that it wants to go lower, but this is only to trap sellers right here. And then one more time, this placement to the upside, and this one is to trap buyers. So people will start buying right here, and finally it will energetically move to the downside. This energetic move to the downside, you will see it on all the examples that I'm going to show you after this. So I believe we have done with the explanation. Let's now just move on to the examples. and you will understand better. So starting with the first example, and this formation happens all the time on all the time frames. It can happen on the weekly, daily, 4-hour, even on the lower time frames like the 1 minute, 30 second. It doesn't matter. The price is fractal, but how you're gonna use it, that's a difference, right? So maybe when it happens on the higher time frame like the daily, now you can frame your idea of going lower or higher based on that, and dig into the lower time frames and look for entries, right? Or look for lower time frames, market cycle shifts, etc. But when it happens on the lower time frames, right, like the 5 minute or the 3 minute, you can take a turtle soup entry, right? And that's how you take turtle soup entries. That's high probability turtle soup. Anyways, this is the Australian dollar against US dollar, the 1 hour chart. As you can see, we have a fair value gap and price expanded lower. It starts going up, tapping into that fair value gap, and now it is giving fake signals that it wants to go lower. All right, people will buy, people will sell right here, but as you can see, it is leaving behind what? Low resistance liquidity. And one more time, sweeping those highs and an energetic move to the downside. So as you can see that this swing high right here is located inside that fair value gap. And when you see this energetic move to here, so this fake break of structure or market cycle shift, you know that this is only a sweep on liquidity to take liquidity from here and fill the rest of that fair value gap. And afterward, energetic move to the downside. Let's move on to another example. So this is another one. We have an order block right here, right? A daily order block. We have also this fair value gap right here. So 2 PD arrays in this case, and price, as you can see, retraced to this fair value gap right here, leaving this equal highs. And what happens next? It starts going lower, trapping sellers. And one more time, energetic candle right here, taking liquidity to trap buyer side now, tapping into this daily order block and energetic move to the downside, to this liquidity, to this draw on liquidity. Let's move on to another example. So another one right here, as you can see, we have an order block, right? Price tapped into that order block, and it's creating low resistance liquidity, stopping sellers right here. Retail trading are selling right here, right? But energetic move to the upside, taking liquidity, tapping into this order block, right? Mean threshold, and then what happens next? Energetic move to the downside. You can notice that in all the examples, when you see the sweep right here, it is followed by an energetic move to the downside. So you know that this is smart money, right? Smart money is operating when you see this kind of moves to the downside or the upside after the liquidity sweep. Let's go to another example. We have a fair value gap right here. Again, this is the daily chart, right? Price retraced to here, right? Started going up. Another retracement, creating this equal lows. Starts going up, right? So this engineered liquidity for later. Retail traders will see this as double bottom, right? And one more time, sweeping on those lows, filling the rest of this daily fair value gap and an energetic move to the upside, right? As you can see, 1, 2, 3, 3 candles to reach the draw on liquidity. One more time, this is the 1 hour, right? As you can see right here. As you can see here, we have 2 examples. We have this one right here, a swing, right? This is I believe an order block or a fair value gap. I really can't remember. Anyways, it doesn't matter if it's an order block or a fair value gap, as long as it is a PD array. But you can notice that it happens a lot on fair value gaps and order blocks. Again, PD arrays like mitigation block or rejection blocks or breaker blocks. Usually we have one tap into that PD array and then reverses. So as you can see, we have a swing high right here, a sweep on this swing, right? And then energetic move to the downside. One more time, expansion lower, leaving a fair value gap, price started retracing to it, right, leaving an equal highs, and then a fake market structure, right, trapping sellers. Retail traders again will see this as a break of structure right here, and one more time sweeping on those highs, and then energetic move to the downside. Let's go to another example. I have a lot of the examples because this happens all the time. So we have this market maker sell model, right? Price right here rated on this swing high, right? And as you can see, all the rates happens with an energetic move. You can notice this too. So a fake break of structure, and people will see this as a buy opportunity, but it is only a fake market structure shift. It's only a liquidity sweeps tapping into this order block. I can't remember also, and then breaking lower and lower with an energetic move. Another example, and this is all the lower time frames. So this here will differ because here you will want to take turtle soup entry. So as you can see, we have an expansion higher, price retraces to this fair value gap right here. It starts going up, and now you are expecting that sweep on liquidity, right? So one more time sweep on liquidity, and this could be your cue to enter. And here maybe you can get a better RR, right? You can enter from here, your stop loss here, but this will give you a better RR, or this will protect you from getting from exiting a break even, right? So maybe when you see this move right here, you will move your stop loss to here. But with this information, you know that you can always expect another sweep on liquidity, creating a higher risk liquidity, right? And then continuing higher. Let's go to another example. Again, this is an order block, right? Price created this swing high right here, engineered liquidity, equal highs, right? And one more time, sweeping on this liquidity, you will see this sweeping on this high and then breaking lower with an energetic move. Another example, the same into this 1 hour order block, this swing high, break of structure and energetic move to the downside. This is very, very important. It happens all the time. When you see a sweep on a swing into a PDRA, you can always expect energetic move to the downside. I believe this is the last example. Now we have 2 more. So as you can see, one more time, you do this fair value gap, and this is the weekly chart. So again, the price is fractal. To this fair value gap, price starts going lower and trapping sellers, and then sweep on this, right, on this swing and breaking lower. We have another one right here. So in this example, we have 2 swing highs, right? This is low resistance liquidity. Price with an energetic move, a fake break of structure into this fair value gap right here, and then what happens next? Breaking lower with beefy candles. So the last example, this is the daily chart. As you can see, price retraces into this fair value gap, started going up, right? So the open, this is the low, and then starts going up. What happens on the next day? A sweep on liquidity on this high, and then, as you can see, energetic move to this fair value gap right here. So this is the first scenario. This is again one of the highest probable liquidity sweeps in the market, and you can use it either to frame your trades. So on the higher time frame, you can use it for bias, or you can use it as entries, as turtle soups entries on the lower time frame. And now let's move on to the second scenario. Now the second scenario, or the second case, is the midnight Judah swing sweep. In order for us to understand this concept, we need to understand another concept, which is the open, high, low, and close, and the open, low, high, and close. Let me draw you an example right here, and you will understand better what I'm talking about. So let's say this is a daily candle, right? This is a bearish daily candle. You will see that it has a wick to the upside, right? And it has a wick to the downside. So this is the open, right? we're going to take a bearish example, and for a bullish example, all you need to do is to reverse everything. Again, this is the open, right? And after the open, price will print the high of the day and then expanding lower. So this is during London and New York, the AM and the PM session. And at the end of the day, it will print the low of the day, right? And then closing just above it. So this is the anatomy of a candle, any candle. But let's suppose this is a daily candle. Now, according to ICT, the open right here is midnight New York local time, right? You will see that after midnight, price will start trading higher, taking some kind of a short-term high to the left. It can be the Asian highs, right? It can be, I don't know, equal highs, yesterday's highs. It doesn't matter. It can be any highs. It can be any high to the left. And then after that, it will reverse and expand lower. So in the context of our video, when you see that after midnight, price started trading higher or lower and breaking a certain high or a certain low, you will know that this is only a fake move, right? To trap sellers or buyers, and price will likely to reverse after that sweep on liquidity, right? So let's just transition into examples, and you will know exactly how that looks like in the chart. So starting with the first example, as you can see, this line right here, so this pink line or red line is the New York midnight open, right? So as you can see on the time axis side here, this is midnight. After midnight, in case you are bearish, right, you will see that price, in most cases, it will trade above, right, taking some kind of short-term high, right, and then trading lower. So in our example, we take these equal highs on the left, right, and after that, reversing to the opposite direction. And if you notice that on the left, we can see that we have this fair value gap right here. So from the previous scenario, the BDRA sweep, the BDRA sweep on liquidity, right? So you can merge 2 or 3 scenarios together to come up with a high probability liquidity sweep idea and trying to catch the reversal. Let's go to another example. Again, the midnight open right here, right? Price after that traded lower, taking this short-term high, right? And we are inside a BDRA, right? So we are merging 2 scenarios together. A lot of traders will see this as a break of structure, right? A market section shift, returning to this fair value gap. They will try to short this, but you know that this is only a fake move to the downside, a trader swing, and then trading higher. So this is a sweep on liquidity. This is called, this profile called the London normal protraction, right? Another one right here. So after midnight, as you can see, price traded above. As you can see, it is creating liquidity, right? Buy side liquidity, creating this equal highs. And after that, a fake move to the upside. And then what happens next? Breaking the lower. This fake move to the upside again took this liquidity from here, tapped into this 1 hour fair value gap, right? And then breaking lower again. All right, let's go to another example. Price after midnight traded above. As you can see, it is generating liquidity from here. So accumulation phase, traded above, taking this short-term high and this failed swing. And then what happens next? Energetic move to the downside. And this is the real move, right? Let's go to another example. After midnight, a break of structure, a fake break of structure, taking this high and then trading lower. Another example, right? Price after midnight started consolidating a little bit, generating liquidity, and then we have news, right? So we have news stop hunt above midnight. So this news right here, this fake move was intended to take liquidity from here, from this high, and then breaking lower. Another example, right? After midnight, price traded above, taking this short-term high. So this is a sweep on liquidity, high probability sweep on liquidity, and then trading lower. And for the last example, as you can see, price started trading higher, leaving this failed swing untapped. So we have a pool of liquidity right here. Traders will see this as a break of structure, but we have engineered liquidity above us. So what happens next? A fake move to the upside, taking both of these equal highs, relative equal highs, and then an energetic move to the downside. You notice that after each liquidity sweep, we have an energetic move to the downside. So this is very, very important. And now let's move on to another scenario. And now moving on to the third scenario, which is the SMT. This is quite simple. Let's say, for example, we have eurusd and GBP USD. So EU and GU. They are both correlated, right? So they move the same way. And let's say, for example, on EU, price rated on a certain swing high, right? For example, while on GU, price couldn't make that new high. So we don't have that rate. So this will indicate that on EU, this is just a sweep on liquidity and price will reverse afterward, right? Let me draw you an example on the chart so you can better understand. And after that, we're going to move on to examples. So as you can see here on this structure, which is the eurusd chart, we can see that we have a break of structure. So how do we know that this break of structure is a continuation, meaning price will maybe retrace to here and then continue on its way, or this is only a sweep on liquidity? If we look to the GU chart, we can see that price couldn't make that new high, right? So this is an S&P divergence, and this indicates that the EURUSD or the euro currency is stronger than the GBP, right? So this is only a sweep on liquidity because we have this divergence. Now, SMT divergence works better when they are located in a point of interest, right? So in a point of interest, meaning a fair value gap, right? It can be swing high, so a major swing high. So swings are also point of interest. So PD array, right? In the PD array matrix, or it can be aligned with time. So the 930 Judas swing, for example, we see it all the times on the indices. And now let's move on to the chart examples, right? So this is the GU, right? The GBP USD, the 1 minute chart. Again, price is fractal, so this pattern happens on all the time frames. And now let's focus on this rate right here. So on here, how do you know that this is only a sweep on liquidity? So if we pull up the EU chart, right? So here you go. And we compare this high right here. As you can see on EU, we have the same low. I'm sorry. And as you can see here, price couldn't make that new low. So this is an SMT divergence between these two lows. And we know that this is only a sweep on liquidity. To make it even more high probable, you wait for a pattern reversal, right? So in our example, we have this inverted fair value gap, right? As you can see here, we broke above this fair value gap, and now we are using it as what? Inversion, and price after that started trading higher. So the third scenario is using the SMT divergence to confirm a sweep on liquidity and a reversal. We have another example right here. So this is the opposite. If we go to EU chart, we can see that we have the sweep on liquidity right here. Right, and we are inside a fair value gap. So remember the first scenario. And as you can see on GU, we couldn't make that new high. So we know that this is only a sweep on liquidity and price will likely to reverse afterward. Again, it is better to not just sell right here. Wait for a confirmation on the lower time frame. And as you can see, we have the change in state of delivery right here. So this is an order block. And we have a fair value gap, a break of structure, price after that retraced, this fair value gap tapped into this order block. Then we have another one right here, a sweep on liquidity, and you are inside a PD array. So these things works together. And after that, as you can see, a drop lower. And now let's move on to another scenario to identify high probable sweep on liquidity and reverses. Another scenario, which is the AMD pattern, or the accumulation, manipulation, and then distribution, right, or the power of 3. And basically price will be trapped into a range, small range, and that's the accumulation phase. And after that you will see a break of structure, a break of that range, either higher in case of a bearish scenario or lower in case of bullish scenario. So that's the manipulation phase, and after that you will see a reversal, and that is the distribution phase. Let me draw an example right here. That's quite simple, to be honest, and you will see it in all time frames and all the times. So basically price is now trapped into a small range. This can be the Asian range, but again it happens on all time frames and all the times. So it's not really related to a certain session only. And after that you will see, in case of a bearish scenario, you will see a break of structure, and this is only to take the buy side liquidity from here. So this is a sweep on liquidity, and also to induce buyers into buying this. And after that what will happen is a distribution phase to the downside, right? So a reversal. And again, this is the manipulation, this is the accumulation, and this is the distribution of shorts. So in our context of this video, when you see a break of structure above a range, right, and you are expecting a bearish scenario, bearish day, you know that this is only sweep on liquidity, and you can anticipate after this manipulation bearishness to the downside, right? If this happens on the higher time frame, after this manipulation you can drop lower to the lower time frame, so you can anticipate market structure shifts, change in state of delivery, or anything, right? If this happens on the lower time frames, like let's say 5 minute or 1 minute time frame, you can, after this manipulation, wait for a change in state of delivery, right, or an inversion fair value gap, and enter. Your stop loss may be above this manipulation move, or you can wait for price to break this low right here too. So this whole move right here, break it, and you can take your entry. So this is a safe entry, but of course it has a lower RR. Now let's go to the examples and show you how that looks like in real chart. So starting with the first example, and this is Australian dollar against US dollar, the 4-hour chart. So as you can see here, we have an accumulation right here, right? So this is the first phase. After that we have a fake move to the upside. Some of you will take this, some of you will see this as a break of structure, and they will buy this fair value gap, but this is only a manipulation move, taking this 3 equalize, right? So this is a sweep on liquidity, and after that a break lower. This is a distribution phase. Let's take a look at another example. Again, I have an accumulation. As you can see, a range right here. This is the 1-hour chart. A break of structure, taking a fake break of structure, taking this high right here, topping into a fair value gap, right? So you can pair 2 or 3 scenarios together, and after that breaking lower, as you can see, to this original consolidation. Let's take another look, and this is perfect. As you can see, an accumulation, right? Price is trapped inside the range, a fake break of structure into a fair value gap, and after that breaking lower. So this is the manipulation phase, right? This is the manipulation link. When price broke below this low, now this is the safest entry you can get from this pattern. So this is the first entry, right? From this order block, your stop loss is above this. Let's take another example. This is the 15-minute chart. So accumulation, fake break of structure, sweeping this liquidity. So after this move right here, you know that this is only a sweep on liquidity, and price will eventually reverse. Another one right here. So this is the same example from the midnight Judas swing. As you can see, price tapped inside the range. After that, a manipulation move, and then a breaking lower. Another one right here. As you can see here, price is tapped inside the range, AMD pattern, sweep on liquidity, and then trading lower. Another one right here, accumulation, manipulation, and then distribution. This is only a sweep on liquidity below this lower right here into this fair value gap. Another one right here, right? And we have another one right here, accumulation, manipulation, taking this equal lows, right? And now you can expect a reversal. So price used this CB as an inversion, right? And then started trading higher into this original consolidation. The last example, as you can see, accumulation, manipulation, and then distribution. This is only a sweep on liquidity. And again, it tapped into that fair value gap. And now let's move on to the fifth and the last scenario of high probability liquidity sweeps. And for the last scenario, which is external to internal range liquidity. Now, this is not really a sweep on liquidity, so this is only a retracement. But if you use it on the higher time frame and frame your idea of going short or long on the lower time frame, you will find it handy. So basically, external, right? So price rate on a certain high right here, right? So an expansion, taking this external liquidity, and maybe price lift a fair value up right here. So internal range liquidity, and now you can expect a retracement to here. So as I told you before, this is only a retracement. But if you use and find this pattern on the higher time frame, like the daily or the 4 hour, you can find opportunities to go short on the lower time frames, like the 5 minute and so on, to this internal range liquidity. This is quite simple. I have talked about this a lot in my channel before. You can go and watch my previous videos. As a matter of fact, my model is based on internal and external range liquidity. And now let's go and see some of the examples that I have. Let's start with this one. So as you can see, price took this external range liquidity, and after that retraces to this internal range liquidity. This is on the weekly time frame. So on the 4 hour and 15 minute, you will find plenty of opportunities to take this retracement to here. Go to another example. And this is on the daily. Price took this external range liquidity, right? So again, this one and this one, this is the most recent one. And after that, it retraced to this internal range liquidity. So again, you can frame your short idea of going lower on the lower time frames based on the higher time frame, right? Let's see another example. Again, on this one. So this is eurusd on the daily. So as you can see, we are using this sweep on liquidity only on the higher time frames, because on the lower time frame, if this is a 5 minute structure expansion and you see a sweep on liquidity, this is not really a sweep. This is a break of structure, and you will not find an opportunity to short to here. You will need to use a 30-second or the 15-second chart in order to do that, and the spread won't let you do that, right? So it's better to use this only on the higher time frame and take advantage of this retracement to here. So if we go one more time frame lower, we have a breaker, price broke that low right here, return to that breaker and this fair value gap. And as you can see here, we have a nice entry on London kill zone. We have another entry on New York kill zone. And if you focus on this price action right here, you can see we have this relative equal highs, felt swings right here. Price did a fake break of structure right here into the fair value gap and the breaker. So remember the first scenario, and then dropped lower with an energetic move to the downside. Let's see if we have another example. So as you can see here, a break of structure sweeping these highs. We can now expect a retracement to this fair value gap right here, and you can frame your short idea based on that, as you can see here, right? Now, I believe this is all for today's lesson. If you have any questions, please tell me on my Twitter account or leave a comment down below, and I'll answer you as soon as I can. Happy trading and good luck.